and welcome to Simply Tax. It's Thursday, May 13, 2021, and now that we've had a few weeks to digest the tax-related changes currently proposed in President Biden's American Families Plan, which is the second prong of his two-part Build Back Better agenda, I imagine what you really want to know is what's the outlook and what should I be doing right now about the possibility of tax change, both from a tax and an investment perspective. So, with that in mind, I asked returning guest and national industry partner Holly Pantzer and first-time guest Jeff Layman, who is the Chief Investment Officer and the chair of the BKD Wealth Advisor and BKD Family Office Investment Committees, to share what they are hearing and seeing on the strategic front, with the discussions around these proposed changes heating up. Now, before we get to my conversations with Holly and Jeff, let's level set with a quick rundown of what these changes are that are targeted at high-income Americans, as the fact sheet released on April 28, 2021 puts it, that are currently included in the tax-related pay-fors that would raise an estimated $1.5 trillion over 10 years and generally follow those that the president campaigned on. If enacted, the plan would increase the top tax rate to 39.6% from the current 37%, increase the top capital gains rate to 39.6% for households making over $1 million, in the practice of stepping up the basis for gains in excess of $1 million or $2.5 million per couple when combined with existing real estate exemptions with protections for family-owned businesses and farms, eliminate the preferential capital gains treatment for carried interest arrangements, eliminate like-kind exchanges for gains greater than $500,000, permanently extend the excess business loss limitation, and modify the 3.8% net investment income tax by removing the wage-based cap for those making more than $400,000. In addition, the president's plan proposes to revitalize enforcement of the U.S. tax system by requiring financial institutions to report information on account flows and increases in investment to the IRS. Now, there are a few notable items that the president campaigned on that aren't included in the current plan. These include a reduction in the estate and gift lifetime exemption from the current $11.7 million per person amount that can be given away at life or at death, curtailing the benefit of itemized deductions for incomes above $400,000, eliminating the SALT cap, creating new retirement incentives, and limiting the qualified business income deduction for taxable incomes more than $400,000. Phew, there's a lot of moving parts in there. And of course, we're also very early in the process, and we're likely to see some changes to these provisions as the White House navigates the legislative process and negotiations continue. It's also important to note that the proposals are just bullet points at this point, and we don't have all the details of how they would work in practice, though we do expect to learn more with the release of the Green Book in the final week of May, which will include additional details and revenue estimates on President Biden's proposals. From an outlook perspective, the outlook on tax change remains uncertain at this point, and there's both momentum and headwinds to enactment this year. And so, with all that said, I am very excited to share with you on the podcast today 2 conversations to help us all cut through the static of the headlines that are swirling right now, starting with returning guest Holly Pantzer. Maybe if you would, Holly, though, I know we've had you on the podcast. It's been some time, though. It was when I think the TCJA was heating up a little bit, so we've had a few things that have happened since then, but maybe just a real quick who you are and what you do.
Sure. Yes. I'm the National Industry Partner for BKD Private Client. I sit in Indianapolis, Indiana, and I work with ultra-high net worth families, multi-generational executives with large companies, just with their income tax and estate and gift needs.
That's certainly part of the reason why I wanted to run some of these questions by you, because we've now had some time to digest some of the proposals from the president's American Family Plan. With that in mind, what approach were your clients taking, or were you hearing from people before the fact sheet and the additional details came out?
Well, obviously, before the election, people were already actively making transfers of wealth. For those who hadn't yet pulled the trigger on making those transfers of wealth after the election, I felt like they got a little more serious about it. And it was interesting. I was talking to Sean Duffin of our valuation group yesterday, and I was like, oh, how are the valuations coming along for the 2020 gift tax returns? And he said, we are so busy because people are actively making 2021 gifts and wanting those valuations right away. So I think people are really trying to assess, okay, like where am I with the use of my lifetime exemption through 2020? What more can I give in 2021 before perhaps the lifetime exemption shrinks back, and really trying to see where those valuations are coming out. I think a lot of activity since the election, and even before the fact sheet, and maybe intensified with the fact sheet.
Yeah.
We'll talk about this more later, I'm sure, but just there was, to me, the surprise that they didn't talk about taking the estate tax lifetime exemption back. And I think everyone thought they were going to. There's a lot of talk of even taking it down to like $3.5 million for lifetime exemptions, $1 million for gift exemptions, a huge retraction. That it was surprising, but I think we all still think it might be coming.
Yeah, and I was going to ask you about kind of surprises, and that was certainly surprising to me, I think, as it was to others as well. What thoughts do you have on that? And maybe, like you said, it sounds like people are still kind of running forward with some of this planning around the lifetime exemption, maybe perhaps despite the fact that it's not necessarily in the fact sheet at this point in time.
Yeah, so I think we've been trying to educate our clients that either way, it's going to go back. With the TICJA, the lifetime exemption had, grown to 10 million and would index with inflation above 11 million, but was going to expire at the end of 2025. I think now we've got a change in leadership and tax philosophy, and people are more, okay, I think it's going to change. And I know it's going to change at the end of 2025. So I really just need to get serious and get moving on these things.
Yeah, that's a good point. Maybe it's not something on the table, or maybe it doesn't make its way into the wherever we end up here. But regardless of what happens, automatically it goes down in a few years. Taking advantage of that opportunity and locking that in now seems to be the thing that a lot of people are interested in getting a little bit more serious about, perhaps, in doing.
Yeah, and I think it's a two-part process to making these large transfers of wealth. The easy decision can be the math, that there's a tax ramification if you don't make the gifts before the lifetime exemption goes away. And then there's the emotional and value system of your family and whether you're ready to make those transfers of wealth to children or grandchildren. And so I think when you think you have time, on the math side, you obviously weigh very heavy on your values and what you want to give or not give to the next generation. I think this has just created a sense of urgency where people have had to digest that decision side of the process if they are driven to save taxes.
Well, I guess in my experience, and tell me if this has been yours as well, but with those that you work with, that a lot of times that second part, kind of the values and some of the interpersonal and what are you trying to accomplish things, particularly when you're dealing with a married couple, is not always the easy stuff. And it takes more time than even sometimes the math stuff to figure out. I don't know, would you agree with that? And then with that in mind, any advice for this kind of current environment, maybe with the things maybe changing?
Absolutely, you're right about that it does take more time. And I think that's where when you meet with a client and then they need to go home, they need to think about it, talk through it, maybe you have another meeting. So that process just does take longer and rightfully so. I think now if people are feeling that sense of urgency because of the tax law, knowing that we've got a cliff at the end of 2025 and potentially changing much sooner with the lifetime exemption, we need to help them look at alternatives. If it would be helping by putting into a trust or putting into a family limited partnership, especially if they have younger children or grandchildren, if they're not quite ready to feel like comfortable that they can handle that type of wealth, if they can put it into a vehicle where there's some family management of that.
Definitely, again, thinking through all the options and getting them all on the table, and it just takes time. But maybe on the income tax side of things, what are you hearing from clients so far in that area? And what are you thinking about that side of the coin?
So I think the most discussion I'm hearing has to do with the dividends and capital gains tax, the thought of it rising from 20 to potentially what the highest tax rate will be is 39.6% that they talk about in the plan. That's a doubling of taxation for many people. And I know they talk about it only affecting 0.3% of the population, but 0.3% of a large population is still a lot of people, and a lot of people very concerned about this increase. I mean, it is for households making over $1 million. So that's still, I understand, a much smaller group, but a doubling of someone's income tax is just it feels very extreme to them. So I think there's a lot of anxiety around that. I don't think people are as concerned about the 37 to 39.6% jump. I mean, no one likes paying more taxes, but that just is what it is. And we've had a short little period here with a 37%. So that's not as much of the focus, but certainly the capital gains and dividend tax rate.
Yeah, no, I'm hearing a lot of that as well. And maybe coupled with that, I'm also hearing this, okay, when is this going to be effective? Or could it be retroactive? That sort of thing. Is that something you're hearing as well? And what are your thoughts on that?
That's interesting because a lot of people had concern before this came out that they thought that they were going to change the lifetime exemption and they thought that was going to be retroactive. So that's more of where I heard the retroactive discussion than I have heard with the income tax. I think generally speaking, we haven't had a lot of retroactive tax law changes. So I don't think people have a lot of concern around that. Not that they would like it if that occurred, but that's not where their heads are right now.
Yeah, no, I would agree. It definitely seems like, at least from okay, maybe it's theoretically possible or it could be done, but the popularity of it from a political perspective would be very challenging, I think, especially considering, yes, it's 18 months away, but next year's an election year and that sort of thing. And so I think with being so closely divided in Congress, it just seems like that would be challenging needle to thread, perhaps we'll say.
Yes, I think it certainly would be unpopular. I mean, we've been a country that's allowed people to plan for their taxes. So I think that would just be a really big cultural shift.
Yeah.
And speaking of the income tax, and I know that you talked about this in the article, that a really big piece that I think a lot of people are analyzing is if you got a lot of baby boomers that have grown their companies and have reached a point of maybe selling those companies, and looking at the analysis of a sale in our current tax system versus if this were to pass, and how impactful it could be on the net after tax of the sale of a company that they've spent their lifetime growing and nurturing, and it could be a real hit. So I think there's a lot of activity there where people are really trying to analyze some big transactions right now.
Absolutely. Yeah. No, I think that's been probably the thing I've been hearing a lot of. I'm going to say almost the most because it's almost divided in terms of some of the things, but definitely how that capital gains rate increase would impact those that are looking to exit a business. Again, because that's something that takes the planning, and you say, do I need to speed up that plan and do something faster here? So it'll be very interesting to see how that kind of pans out and how the conversation advances and so forth.
I think people won't be able to make a decision. Selling a business is a huge decision, but they won't know for sure where the taxes are going to land, which might motivate them sooner rather than later. But anecdotally, I would say our corporate tax partners are pretty busy right now with analysis. So people are paying attention to this and really trying to figure it out.
Yeah. Well, like you said, for many, they're business owners or have the family-owned business. That can be the most significant asset, and the sale of it or the transfer of it is the most significant tax event for them. You can understand why that would be a cause for concern or alarm bells to see the potential of doubling or nearly doubling tax rate on that exit.
Mm-hmm.
But you mentioned planners and that we're built around that. What are some things that you can do to plan right now? Obviously, there's some uncertainty here. We don't know exactly where things are going to land, maybe if provisions are going to change, even when they're going to be effective. So, yeah, what do you do?
Yeah, I think for the individuals, for right now, it's a little bit of a wait and see because you don't want to have a knee-jerk reaction to something that might happen. And even with the capital gains rate, if they're saying we'd like to double it to 39.6%, well, there's going to be a lot of negotiations between now and when the tax law changes. And what if it's 28%? Would you have said, oh, I might have held it then. I wish I hadn't sold just to get that 20% tax rate versus a 39.6. So I think most people are in a sit and or wait and see mode right now. I think where there's activity is what we talked about is gifting and lifetime transfers, just because I think that people feel that's a known change at some point, whether in a year or in 5 years.
You make a good point, because I had somebody asking me this the other day of, well, okay, do you think that's going to take the foot off the gas a little bit on some of these estate planning transfers? And my reaction was no. What do you think? It sounds like no. It sounds like it's still heating up and it's still very much in the conversation.
Yeah, very much so. And I felt that way when thinking about what I needed to be doing when talking with my clients and making sure I'm communicating these changes, whether sooner or at the end of 2025. But like I said, talking to Sean Duffin of our valuation group was affirming that this is happening if he's really busy with 2021 valuations.
While we know that the estate side's maybe off the table for now, short term until it expires anyway, rolls back, I should say. But obviously there's this provision in here too that would look at eliminating the step up in basis. There's $1 million per person that you would be able to get. And we don't know exactly how that would operate, but are you hearing any concern about that, or maybe some planning around that elimination of the step up?
Well, I'm hearing a lot of concern around that.
Sure. Yeah.
For sure. I think it's hard to plan for again, because you're balancing, well, do I gift and pay gift tax? Then I'm just gifting carried over basis anyway. And then the interesting little point about this is that I don't think we're 100% clear on what they're saying is there would not be a step up in basis. But does that mean the person who inherits the assets has carryover basis, or does that mean there is an immediate gain recognition? And if it's an immediate gain recognition, that feels onerous, really onerous. But if it's carryover, not great, and there's an economic effect to that, but not as onerous.
Yeah, and that immediate, and the need to plan for that too, just from a liquidity perspective, if there's assets that going to continue on being held by the family from a legacy perspective.
For sure. And there's just an old saying, with real estate, we better make sure you die with that real estate, because people have depreciated the property. And that's the beauty of the tax side of real estate, that you have this depreciation, you die and you get this step up in basis. And I think this could be the new, well, you're going to have to stay alive until it gets fixed and goes back to a step up in basis.
So that's a very interesting point, and that's a big part of planning, is managing the income tax side of things and being intentional about what assets are in the estate and outside of the estate, and particularly with real estate, because that's a good one that you'd rather own it versus having it someplace outside of the estate for that reason.
That's right.
I guess just overall, where we're sitting here today, obviously still digesting what even the fact sheet means, and maybe what it doesn't mean, because we don't have the details yet. What's your overall thought that you would leave the audience with?
These are big changes. And so I think that we do need to pay attention and watch as they negotiate them. And then I think when the time is right, and it could be different times for different people, analysis can be done to make analytical and logical decisions. Because I think a lot of emotions come up with a tax law proposal this big, and that's understandable and natural. But at the end of the day, what we can help with is the analytical side of things and the calculations.
I like that. Yeah, the analytical, and keep the emotions out of it. Like you said, you start making reactive actions instead of really weighing all your options. And well played, well said. No, thank you for that. And we want to maybe ask a few other questions off the topic at hand, just to get a little bit more insight into you and as an advisor and maybe as a leader. So we'll start with hopefully an easier question. I don't know if I say it's easier, and then I think to myself, no, that might be a hard one for me to even answer. But what is your favorite band or artist? Any guesses? I'll let you find out for yourself with a quick video segment from our interview over on our YouTube channel. We're kicking off a new special segment with additional insights into our guests to help you get to know them a little bit better. All right, so in addition to the tax angle, another related and frequent topic of discussion is the investment impact of tax increases. Our next guest breaks it down, both in terms of what to watch for and what strategies to consider amid the uncertainty. Let's start with learning a little bit more about his background.
I'm Jeff Layman, Chief Investment Officer of BKD Wealth Advisors, so ultimately responsible for the management of over $5.5 billion of client assets that our firm oversees. So I've been with BKD Wealth Advisors since March of 2000, so just over 21 years now.
It's a big number. You think, I don't know, does that keep you up at night kind of thing? Just thinking about that and the responsibility there?
It is a big responsibility. I'm fortunate to have a really experienced and long-tenured team that works alongside me in the investment process. So our team of 9 portfolio managers averages over 20 years of industry experience, but more than 13 years with BKD Wealth Advisors. So I take a lot of pride of ownership in what we're doing and do a really good job of implementing that portfolio designs.
We were chatting a bit before we even hopped on the interview here about the fact that we've seen some kind of a ramp up, maybe we'll call it, with some proposals on the tax side. And obviously that can have an impact on the investment side as well. I mean, these are both on the individual as well as the corporate side of things. But maybe just out of the gate here, how has the market reacted so far to the Biden administration's proposals?
When President Biden first announced his intentions or his proposal for tax rate increases, the market sold off about 1% that day, which the media put a spin on that. That was a big response to these proposed tax changes. That's actually a fairly ordinary range of return in a typical day. I wouldn't read too much into that. We would look at that as a fairly muted response. I think there's a couple of reasons for that, Damien. One is that most of the proposed changes are very similar to what President Biden insinuated in his campaign platform back in November. So not a lot of new surprises or change there. And then the other thing I think that's even more important is that most investors don't believe that the actual tax increases will be as substantial as those that are proposed. Now, it's going to vary a bit across the different areas of concern here, but there's a thought that this is going to be subject to negotiation and compromise, and that the ultimate tax increases won't be quite as big as the headline shows today.
Along those lines, like you said, it's almost like an opening volley here, starting off with the proposals. It's going to go through the process and maybe change along the way and get negotiated. So what will you be watching for in those negotiations?
Now, from our standpoint, from a portfolio management standpoint, and what seems most important for the majority of our clients would be the proposed changes to capital gain tax rates, qualified dividend tax rates, and then also the estate exemption amounts as well. So these are three key areas for our clients. Also, any compromise in the area of corporate tax rates would also be welcomed by the stock market. So, the proposal here is to take those rates back up from 21% today to 28%. And, that in and of itself, all other things being equal, would reduce corporate earnings by 8 to 9% if that were to occur. So once again, any reduction there would be very helpful as well.
An interesting aspect of it, because I know there's been a lot of focus and attention on the capital gains rate, and then there's that indirect impact and how that would hit, maybe based on history or experience that you've seen. Any more that we should be thinking about or be looking for with that impact of that corporate tax rate?
Historically, and there have been various occasions over the years where corporate tax rates have been raised. Ironically, the impact on stock prices in those years has not been particularly remarkable or consistent. It hasn't had a particularly negative impact. But once again, you have to really look at it in the context of everything else that's going on at the time. And when we think about the current environment, Damien, we're looking at a year when corporate earnings are expected to reach all-time highs in 2021 and rebound more than 30% from the depressed levels of last year. So when we think about higher tax rates impacting corporate earnings to the tune of maybe 8 to 9% reduction in profits, it's in the context of an environment where earnings are going to grow pretty rapidly this year. So the contextual part of that is very important to interpret what's going on with stock prices.
With that in mind, that how that could maybe impact value and so forth and stock prices, and then again with the prospect of these capital gains rates going up, are there strategies that investors should be thinking about right now?
The answer is yes. I would say, with our firm at BKD Wealth Advisors, we've been very sensitive to tax implications of what we do in terms of investment management consistently over time. So fortunately, tax management's been an important part of our process for many years and consistently over time. And so there are things that investors can do to mitigate the impact of taxes. One of the things that we do in our portfolios is build the core of our stock portfolios with ETFs and index funds, which creates a very tax-efficient holding. We also take a very active approach to tax loss harvesting, and 2020 provided a really great example of that, because many firms will tend to look at tax loss harvesting in the fall of each year as a kind of a year-end activity. Well, the losses existed in the big drawdown that we had in March and April of last year, and by booking those losses allows the opportunity to offset gains later on. That's been an active and consistent part of our approach as well. Additionally, a process called asset location, which essentially, when we look at an overall portfolio, will seek to put the least tax-efficient investments in tax-deferred accounts when possible, so that those distributions are sheltered from taxes as well. And then finally, gifting appreciated assets. We assist our clients each year with that approach as well, which is a great way to fulfill their charitable intent and do it in a way that's also very tax wise. So all of these things are in place. We're starting from a very strong base in terms of tax efficiency. We'll likely make some tweaks to our approach once we know with more certainty how tax rates will fall out going forward, once we know what the final outcome of those changes will be.
The concept of maybe the ETFs and being a little more tax efficient, could you break that down a little bit as to maybe why that is?
Generally, most ETFs and index funds are replicating a broad market index. They're essentially owning all the stocks in the broad market. There can be changes to those indices over time, but those are generally pretty minor, pretty small. So they tend not to create a lot of capital gain distributions or pay distributions. So your gains from ETFs tend to be deferred until you actually sell the position at some point, which is in our control, in the client's control. So very efficient from a tax standpoint, basically generating the market's return with little tax impact.
I love talking about tax. We could talk about tax all day long from my perspective here. Maybe just looking at the market more broadly, where we are right now and maybe the outlook as we continue on and hopefully maybe emerge here a bit from the pandemic we've been contending with. What is the outlook and what have we seen here recently from a market performance perspective?
Yeah, so the first thing to know is, and keep in mind that we're now making comparisons both in terms of economic data and earnings data to a pretty tough time a year ago. So when you see some of these year over year increases, it's marking from a pretty low level. So that's the first thing to keep in mind. But even having said that, the US economy is expected to grow at the fastest pace in 2021 that it has in over 35 years, with real GDP growth somewhere in the neighborhood of 6 to 7%. Now, to put that in perspective a bit, that's roughly 3 times the pace of growth that we've had here in the last dozen years or so. So very rapid growth expected. What's the cause of that? Well, there are really 3 things in our view. There's been a tremendous amount of stimulus applied to this economy in various waves, and this is all well publicized. In fact, it's one of the reasons that tax rates are likely to go up is to help pay for all of those programs. That's created a significant boost to the economy. The increased vaccine distribution across our population has also been very important because it's allowing cities to reopen and communities to reopen and economic activity to normalize. That's a very important piece of the puzzle as well. And then the final piece, which honestly can't be underestimated, is an immense amount of pent-up consumer demand. And so when you pull these things together, the economy's reopening, people have more money in their bank accounts than they normally would because they've gotten stimulus checks, they've gotten expanded unemployment benefits, all these things. Once things reopen, the American population wants to get out and do all of the things that they haven't been able to do over the last year, whether it's going out to dinner, taking a vacation, and so on. That pent-up consumer demand is expected to provide a significant boost to the economy in 2021. Now, having said all that, the current level of the stock market really factors in. The thing to keep in mind with stocks, they're always forward-looking. They're always looking at what's expected to happen. And this rebound in the economy has been well acknowledged and is represented in current stock prices. So even though the economy and corporate profits are expected to grow very nicely this year, we expect market returns to be a bit more muted because current levels already reflect that.
A positive outlook, especially when you're talking about 3 times the growth rate and so forth. And that's definitely some good news from that perspective.
The other thing, oftentimes investors will have the fear of the next big downturn. In other words, we've come through a really tough year. Stock prices are at all-time highs, or in fact, they're up 12% year to date. So shrugging off the concerns about tax increases. So in that environment, oftentimes people get concerned about the next big downturn. And the only thing I would say about that is when you have the sort of economic growth that we're anticipated to have this year, it'd be extremely rare for stock prices to experience a major correction. Doesn't mean they go up 30% this year, but that should help keep a floor under prices and reduce some of the downside possibilities. Now, that's excluding any extraneous event that we have a resurgence in the virus or some other unexpected factor that could derail things, but it should keep things in pretty good shape in 2021 market-wise.
Maybe we'll do kind of like a wrap up here, maybe of thought that you would leave the audience with here. Where we're sitting with the possibility of some of these changes, the uncertainty there, and the outlook and approach to take going forward here.
Yeah, I think that the one thing I would leave investors with is that at any given point in time, there are multiple factors that can influence the level and direction of stock prices. As people, we tend to focus on what's newsworthy of the day. Last fall, it was the presidential elections. Obviously, the pandemic has been the focal point here for the last year. Now we've got higher potential tax rates. But really, not any one factor is typically going to determine the direction of stock prices or the level of prices. It's really a combination of all of these factors, and it's ever changing. And that's a really important thing to understand. And this is why we feel that determining the right and appropriate investment strategy for yourself or for each individual, and then sticking with that, having the discipline to stick with that investment strategy over time is so important to success. So there's a lot of noise, a lot of information, more so now than ever, coming our way. And it's important to, once again, maintain that discipline to reach financial goals over time.
Great advice, great insight. I appreciate it. I always enjoy reading your quarterly updates and when we get to talk and catch up and get insights from you, because I feel like you do have a very good pulse on the situation, or finger on the pulse, I should say. And so thank you for that. And
thanks.
There's a kind of maybe a little wrap up segment we'll do where get to know some of your thoughts, get your insights there, maybe a little bit more about you. We'll start with an easy one. What's your favorite band or your favorite artist? Get Jeff's answer with the behind the scenes special segment we recorded together that's available on our YouTube channel. As we discussed today, the tax change conversation is just getting started, so it will be important to stay up to date. We'll take a deeper dive on some of the topics we discussed today and give you the latest update in our webinar on June 10, 2021 at 2 p.m. Central. You'll find the link to sign up for the webinar in the coming days after the May 13 release of this episode, and show notes available at bkd.com/simplytax. That's where you'll also find a link to an article examining the American Families Plan with a look at the potential impact of a hypothetical sale of a company with an enterprise value of $100 million. Finally, if you haven't already, please let us know how we're doing on Simply Tax by leaving us a rating and review on Apple Podcasts or wherever you get your podcasts. Ratings and reviews go a very long way in helping others find us. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.